Well, gold's glitter is timeless, but this festive season, it's also priceless. With the yellow metals prices touching record highs and silver also following the lead. The question on every investor's mind ahead of Diwali is to buy, to wait, or to look elsewhere. So we are turning the studio into a strategy room. We have gathered your burning questions from across the internet and brought in the sharpest minds in metals to help you invest and crack them open. Well, welcome to this edition of Commodity Champion Special. I'm Nigel D'Souza, and without further ado, let's dive into the festive season's golden puzzle. Joining us on the program today is Feroz Aziz, the joint CEO at Anand Rathi Wealth. We have Chirag Seth, the principal consultant of India at Metals Focus, and Kunal Shah, the head of commodities research at Nirmal Bang. Hi, gentlemen. Thanks a lot for joining in. And we've got a lot of queries that have come in there. So let's get straight to the first one that's on the show. We have Ramesh Jain from New Delhi, who brings us this query. And it's a very valid one. He's saying last year has been very good for gold, but, while equities have slumped. Now, the question is between gold, equities, and fixed assets, what should the split be? Well, Feroz, let's come across to you. What do you make of this? Asset allocation is top of mind. Equity investors, they've been left behind, but most housewives, well, they're dancing away to the bank because they're the ones that have seen a 50% appreciation in gold prices. How do you read this?
Yes, Nigel, when it comes to asset allocation, the classic ways of doing asset allocation, I personally think you have growth assets and protection assets. So if you're going to have debt in your portfolio, at least half the debt of your portfolio should be gold. Like, for example, in my portfolio, or most wealth managers don't have debt in their portfolio. Will gold beat equities over long periods of time? It can still beat Nifty, but the answer is no. So if you look at the 5-year rolling return of gold over the last 15 years, you'll be surprised to see that gold's 5-year rolling return is 8.32% is the mean. And the best case is 18%, 17.99. So what I'm trying to get to is that if your monies are 5 years, then your gold allocation should be half your debt allocation. If you have near zero debt, it's okay to not have gold. That's point. So what should be the asset allocation? I would suggest at least 75, 80% in equity for long-term monies, and the residual divided between debt and gold, 50-50. And if your money is short-term, for example, because gold does beautifully well in the short term as well. So if you look at the 1-year best return ever in the last 15 years, rolling, has been 58% for gold, and minus 21% is the worst. So point I'm trying to make is gold is more of a trading instrument or a debt replacement is what data clearly points out. If you look at on the rolling basis, Nifty beats gold hands down. On a 10-year basis, Nifty would beat. So swap your debt to gold as much as you want.
Okay, all right. And Feroz, that's an important point because I was looking at global view as well. An ideal portfolio is normally 60% good quality equities and 40% could be debt. But now the call is that, in fact, maybe it could be 60-20-20 between equities, gold as well as debt. And in your case, as you're telling us, 75 to 80% equity over a longer term and the remainder split between debt as well as on gold. But let's get in Kunal into the discussion. Kunal, I wanted your view. Gold has been really glittering. But the one that's catching up now is silver. And in fact, in the recent past, it's outperformed gold. But we have seen this in the past, right? That $50 per ounce mark on silver. 1980, 2011, and 2025 as well. Can it get past this $50 an ounce? And then, in fact, it could be in for a bigger breakout. How do you read silver at current reckoning? And what would your investment advice be between the two?
Okay, so the 1980s $50 for silver was one of the major reasons for that was the cornering of silver by Hunt Brothers. So that had nothing to do with fundamentals. Now, if you look at what has happened in the silver market, the market is a major supply side shortage story from last almost 7 to 8 years. where we are seeing a constant deficit year after year. Every year, the deficit has ranged between 7 to 12%. And clocked with that, we are seeing some of the largest producers of silver, some of the largest mines of silver are getting exhausted. So in Mexico, top two mines of silver are likely to get exhausted by the year 2026. So if you look at the supply side, is continuously getting weaker, and at the same time, the demand side is getting stronger and stronger with solar. And look at the new demand, like the development of data centers requiring a lot of silver. US, we are aware about a lot of new data centers are coming up across the globe, for that matter. So on one hand, the demand is rising exponentially, and the supply side is not picking up at all. So this is the perfect storm in commodities. Whenever there is this kind of proposition, when there is a major shortage is developing in this complex, the upside prediction becomes very difficult. So if you say that silver price will go to $55, $60, most likely you are going to get wrong. It can really shoot up and even breach those levels quite easily, because for silver to stabilize, we desperately need supply side to respond, and that is not taking place at this moment. So we believe that with the bouts of correction here and there, silver is a very volatile metal. The trajectory for silver for next 1.5 2 years still going to be very bullish. And whatever correction, whatever dips, whatever profit taking, what we see over a period of time, that should be used as a buying opportunity. And we remain very optimistic about the overall outlook of silver going forward. And we are very bullish.
All right, got that, Kunal. In fact, the Hunt brothers, William as well as Nelson in 1980, they cornered most of the silver stock that made silver spike up. And then silver lost its way from there. 2011 as well, we did see that speculative action. But as Kunal is mentioning, now we have a fundamental, argument for silver to move off from here. There's a deficit, and the amount of demand as well with regard to silver being used across various platforms is increasing. So he believes fundamentals could hold silver this time around in good stead. Coming across to you, Chirag, then, what is the commodity that you're most bullish on? You have precious metals that have done well, both gold as well as silver, but copper is the new gold as well. We've heard that. What is your reading of it? And in the pecking order, what would you bet on?
Well, Nigel, I won't be able to comment on base metals since we are a precious metals consultancy company.
Okay, so let's talk about gold, silver, as well as platinum.
I think, if we look at, and Kunal has covered it very well, I think silver is one that we are extremely bullish on. We've been saying this for the last couple of years. I think in terms of silver, there are multiple things, you mentioned about 2011, and I would say, everybody say this time is different, but this time it is really different for silver, given the fact that you've got now both demand and supply kind of helping silver, prices. You've got essentially in last 8 to 10 years about 500 million ounces of drawdown of silver stock. So you are really seeing, demand kind of pick up, especially because of the new usages. So you've got photovoltaic, which is essentially solar, EVs, and also defense equipments where silver demand has seen, consistent growth. So I would say silver is something that we should be looking at. And I think gold also still interests us quite a lot, given the fact that it's a fear asset at this moment. And given the fact that the world is not stable, both geopolitically and economically, I would say having a negative view on both in gold and silver would be, harakiri.
Okay, all right. Well, we've got to take a short break, but Firoz, just coming across to you, the last 12 months have looked very, very bright for, gold as well as silver, while equities have struggled. If you had a 24-month horizon from here on, do you think equities actually outperform from here on, give and take everything? The last year has been difficult for equity markets on various parameters. But the way ahead, would you be betting more on equities doing well? We're talking about a 24-month horizon.
Yes, Nigel. I think like I had always said, equities and gold complement each other. But yeah, having said which, I would say that on Nifty also, because we've already gone through a 1 year time correction, almost 7% price correction, 12% earnings correction, I would say that there is some degree of pent up tension in Nifty for it to move up. The shorts, of course, you track it best. I learned it from you. The FII shorts are at about 92%. If there is any short squeeze, that could be tremendous. In my statistical estimate, 53 lakh crores is supposed to come from domestic institutions in the next 8 years. 15 lakh crores has come. The total free float of the 524 stocks in MSCI small cap index of India is only 34 lakhs. 52 lakhs is expected, crores is expected, 34 lakhs is the free float. So prices, the stocks will transact at a higher price over the next few years. So I would say it will be difficult for gold to beat on a compounded basis 3 years. But having said which, Nigel, quickly, 30 seconds, I checked the worst, in the last 12, 24, 30 months, whenever Nifty was negative, I took the 12 negative months of Nifty, and all those 12 negative months, gold was positive. So I'm trying to create the hypothesis that they are negatively correlated assets and they complement each other. Is the point I was trying to get.
That that graphic plate on the screen, in fact, is telling you the picture out there with regard to when the Nifty doesn't do so well, gold, in fact, has done well, and that could possibly reverse as well. But Feroz, Chirag, as well as Kunal, requesting you all to stay with us. We'll slip in a short break. We'll come back. We'll continue answering all your queries. Don't go anywhere. Well, welcome back. You're tuned in to Commodity Champions, and we have our guests with us who are ready to answer all your queries. We have Feroz, Kunal, as well as Chirag who are joining in. Well, let's focus on, gold, silver, as well as copper. And we have two queries that have come in with regard to this itself. So, Kunal, coming across to you, the first query is coming in from Nikhil Kapoor from New Delhi. He's saying amongst sovereign gold bonds, gold funds, physical gold and ETFs, which one is the best investment tool according to you? So if you could help us out with that. And also we have Gautam Jain who's asking, what's the best way to buy silver and copper? So I would like your view on copper as well. You already told us on silver, you're quite bullish. So you can answer both these two queries. Kunal, coming across to you.
Yeah, so as far as the best way of investing, earlier it used to be sovereign gold bond because it was giving you 2.5% interest every year. And also the price hike, whatever you are getting. So, but now we are not getting any new tranches of sovereign gold bond. So that remains out of question right now. So now in current time, I think gold fund and gold ETF, those remains one of the best ways to invest in gold. We are seeing every day the inflows in gold ETF have been increasing quite rapidly and with leaps and bounds across the world. In fact, last month, September month was one of the best ETF inflow month for gold ETF. So that is the smart way rather than investing in physical gold. I think this is the better way to invest in gold. As far as your second question is concerned regarding silver and copper. So in silver also we have a silver ETF in India, which have done reasonably well in terms of volumes, in terms of the way the AUM has expanded. Copper, we do not have copper ETF in India as of now. So copper, I don't think so. You can invest through ETF. The best way you can invest is you can buy it on MCX futures and then take the delivery and keep it in a vault. That is the only way. But I think in times to come, we will see copper ETFs also likely to get launched in India going forward. So that has been a trend internationally. We have copper ETF in US, but in India, that's not the case. So silver and gold ETFs are a much better way to invest in.
Got it. All right, Kunal, coming across to you then, Chirag. Sanjana from Bangalore, in fact, is asking a similar query with a little bit of a twist. Her query is it a good decision to buy gold and silver ETF at current rate? And the important part is the split. So Chirag, tell us the split between gold as well as silver. If you're allocating, say, 100 rupees, how much of it between the two?
So I think, Nigel, it's very important to understand is that gold is a strategic asset, whereas silver is more of a tactical, investment. And I think that's very, very important to understand that with silver comes with its own set of volatilities. You'll see high prices, you will see big corrections coming in. I would say if one is looking at a long-term investment, I think gold actually helps you quite a lot. And I would say anybody who is an investor should have at least 10 to 15% of gold in their portfolio. At the current moment, given the fact that silver fundamentals are much better than gold, I would say having silver exposure through ETFs or silver exposure through digital silver or physical silver would work well. So at this current moment, if somebody is looking at 20 to 30% of their investment into gold and silver, I would say probably having 60% silver and 40% gold would make sense. With regards to whether current price is good or not, I think fundamentals still support higher prices. The market is clearly in momentum, but one should be ready for high price volatility and corrections at any point of time.
Okay, all right. Got that. Thanks for that. Well, before we wind down, Feroz, coming across to you because you've got another query. And the query is, are balance advantage funds better than multi-asset funds? Or is it the other way around, considering the risk reward in the current rate cut, gold price for the next 3 to around 5 years? What's your view?
Nigel, I would say to Gautam that a multi-asset fund would be better because the balanced advantage fund switches between debt and equity alone. If you give the fund manager a larger canvas of being multi-asset and moving it around, that will be better. And you would be taking on the advantage, the biggest advantage of delegating into the fund manager to move between gold, silver, and debt and equity. You are getting a tax advantage because mutual fund managers don't pay tax on any change, right? If you bought an ETF, for example, and sold gold before 2 years, you're going to have marginal tax rate. So point is, you take the multi-asset fund, give them a larger canvas. Having said which, Nigel, I would want to add on how to participate in gold and silver today. I would disagree to invest in ETFs, especially when, like Chirag Saab said, that silver is a tactical allocation. Whenever that is going to happen, when we did a study of buying futures using MCX, the interest cost or the roll cost, as you call it, is just 5-6%. So if it's 5-6%, if I'm going to be investing in silver for 4 months, if I'm tax agnostic, that's the best way to take exposure. One of my clients has 65% in equity, uses 10 rupees of that as margin and goes long on gold 65%. And that reduces the volatility. So that's a better instrument, especially given the fact that all instruments under 2 years will have the same marginal tax rate.
Okay, all right, gentlemen. We appreciate you joining on the show and giving us your take. It's been a healthy discussion. Thanks, Feroz, Chirag, as well as Kunal, for joining in and giving us your view on how do you see asset allocation and between commodities as well. What's your view on all of these metals? Well, on that note, we'll wrap up on this edition of Commodity Champions. That's all the time we have today. Thanks a lot for watching.